transportation. This is Eric Lee, your presenter for today. We will be starting the session proper at about 7:02 p.m. Let's give some time for our friends to join us. Meanwhile, please sit back and relax. I will speak to you soon. Thank you for joining us for our live webinar on the future of transportation. This is Eric Lee. I'm a sales director with Phillip Nova. In today's webinar, we will be discussing the outlook of transportation industry and how we can invest smartly on it. Before we begin, I would like to do a sound check. If you can hear me loud and clear, please type yes in the question box. Also, during the webinar, if you have any question, do type them into the question box and I will address them during the Q&A session at the end of the webinar. Great. Looks like everyone can hear me clearly. So let's begin. Please find included the disclaimer for tonight's session. Please note that the information provided today is for education purpose only. A quick introduction of myself before we begin. As mentioned, I'm a sales director from Phillip Nova. I joined Phillip in 2004 and have more than 20 years of experience investing in the financial market. Apart from servicing and advising my clients on investment-related matters, I also spend a lot of my time researching the markets, covering all angles such as financial analysis, chart analysis, market cycles, as well as intermarket analysis. All this in the bid to improve our edge in investing and sharing these ideas to my clients. In today's webinar, I hope to provide a brief background and overview on the transportation sector, its outlook, and some key factors to pay attention to. At the end, I will also be providing some investment ideas for your consideration. In 2015, a tiny startup out of Southern California started the first scheduled ride-sharing service exclusively with electric vehicles, also known as EVs. It started small, with daily shuttle services between Los Angeles and Las Vegas. Over time, routes expanded to other locations in Southern California. All in, more than 4 million kilometers were traveled. But what's cool about this accomplishment then was that more than 90% of those kilometers were driven by an artificial intelligence, AI. That's right, the cars that drove themselves. The driver for the shuttle routes only touched the steering wheels less than 10% of the time. And this wasn't a control experiment like what we have at the NUS Smart Shuttle, which are traveling within the campus compound at a speed of 10 km per hour. This was a real commercial service run by a for-profit company called Testloop, with real paying customers who rode those millions of kilometers. Testloop EVs drove about 27,000 kilometers per car per month. The company generated US 17,000 per car per month, which is about 63 cents per kilometer. Testloop has since suspended its shuttle service in 2018, citing a number of reasons such as not getting the necessary government permit and the lack of charging infrastructure. However, this little experiment the company did gave us a glimpse into the future of transportation. The data collected from these millions of kilometers provided some incredible insights. In the year 2002, the world was introduced to the future of transportation in a science fiction film by Tom Cruise. The movie Minority Report was directed by Steven Spielberg and set in Washington, D.C. in the year 2054. Electric vehicle and autonomous driving was nothing new in 2002, but it did not move beyond school science projects or someone's expensive toy experiments. But through the visual effects of Hollywood, we get to see how it may look like in the future when technology finally catches up with our imagination. So what are the technologies needed to make self-driving car works? Waymo, a subsidiary of Google's parent company, Alphabet, is one of the biggest investors in autonomous vehicle technology R&D. It has filed 338 patents between the year 2010 to 2017. Within the car itself, we can roughly group the technologies into electric motor, sensors, supercomputing processors. Infrastructure-wise, we need renewable energy, 5G communication, artificial intelligence, cloud computing, and many more. And the good news is that these technologies are already available. They are constantly evolving, and their acceleration will only get faster. So let's tackle the low-hanging fruit first. Over the next 10 years, the global automotive industry is expected to face one of the most significant changes in its history: the replacement of internal combustion engine, also known as ICE, vehicles with electric vehicles, in short, EVs. For your information, ICE, ICE refers to internal combustion engine, and these are the cars that most of us are driving today, which require the pumping of petrol. As you can see from the chart, EVs are seeing strong year-on-year growth in some Asian markets. For example, it's growing by 28% in South Korea, 76% in China. In the United States, it is growing by more than 40% and over 100% in certain European markets. Industry experts are expecting these double-digit compound growth rates to continue over the next decade. And personally, I do think that the Deloitte's projection shown here is too conservative. Let me show you why. Take a look at this picture. It's from the Easter Parade in 1900, New York City. The parade is fully made up of horse carriages then, which is the primary mode of transportation at that time. However, if you look close enough, within the white circle, you will be able to spot the only car among the horses. Fast forward 13 years. In 1913, this picture had changed completely. Here is a picture from the same parade 13 years later. Can you spot the only horse carriage in the white circle? Within 10 years, cars made horse obsolete as a mode of transportation. Let me show you another example. The first mobile phone call was made in April 3, 1973 by Motorola engineer Martin Cooper from 6th Avenue in New York City. He made that call to a rival from Bell Lab at AT&T to declare that his team had created the first functional portable phone. Motorola spent the next 10 years overcoming technical and regulatory hurdles and began marketing the phone in 1983 with a slimmer model that cost $4,000 a piece. Few people can afford it then, or see the need of owning one. But over time, as technology improved, costs came down, and more people became familiar with the benefits of mobile communication. The social buzz started to grow, and usage increased gradually. At a critical inflection point, cell phones finally achieved the pricing, convenience, and social acceptance to be a well-sought item by the general population. In fact, the more cell phones become popular, the more features were added in. They became a must-have. Not having one became almost unthinkable now. Sales and profits then grew exponentially for companies selling mobile phones. In 20 years since it was made commercially available, almost 70% of the population in the United States owned a phone. What I have described with the emergence of cars and cell phone technologies are not once in a blue moon phenomena. In fact, this phenomena is known as the S-curve effect. This pattern applies to the introduction of new technologies across all industries. The chart reviews the growth curves of the major tech innovations since 1900. At the left side of the chart, innovations of 100 plus years ago, like electricity, telephones, and automobiles, took decades before their maturity. In contrast, recent tech innovations have required only a few years to achieve maturity. The pace of innovation has steepened. I believe this will be the same as well for the EV revolution. That is because the cost of driving EV will drive consumers towards quickening the pace of change. Consumers will not just be buying EV cars because they want to go green and save the earth. They will buy EV simply because it is just cheaper and better than a conventional ICE car. So let's discuss briefly on the two cost advantage of EV over ICE cars. How much does it cost to charge an electric car? Beg your pardon. When you are driving a gasoline or diesel vehicle, calculating fuel cost is quite easy. You know how much you are paying per liter and how much it costs to fill up your tank and how far one full tank can roughly travel. When it comes to the cost of charging an EV, it is a little more complicated as there are different levels of charging, which comes at different costs. This depends on several factors, including where you charge it, the price of the electricity, and at what time you charge it. With all the variables, it is best to look at the average amount which is spent per year per vehicle. The typical American family spends about US 1,900 in petrol in the year 2019, driving an average of 21,000 kilometers per year. In comparison, a study done in 2018 found that EV costs less than half as much to operate, coming at around US $500 per year per vehicle. How about the maintenance costs? A conventional ICE car has more than 2,000 moving parts. The EV has 20 or less. That is why we are seeing so many EV startups making the headline nowadays, as they have less variables and assembly process becomes simpler. Basically, anyone can build an EV car these days. That's why you even have EV built by a team of university students that can beat a Porsche in a race. Because it has less moving parts, EV needs less maintenance costs to do so as well. According to a study by the U.S. Office of Energy Renewable um, ICE Office of Energy and Renewable Energy, sorry, ICE vehicles cost 6.3 cents per kilometer to maintain versus an EV which costs 3.8 cents per kilometer. The US General Service Administration reported that government-owned light-duty vehicles traveled 3.15 billion kilometers in 2019. So at 6.3 cents per kilometer, ICE-powered government vehicles would cost about 198 million to maintain. Over the same distance, but at 3.8 cents per kilometer, if all the government light-duty vehicles were fully electric, the maintenance cost per vehicle would be US 120 million, saving the government 78 million per year in maintenance costs. If we include the fuel cost saving we mentioned earlier, the savings will be even more significant. And partly because of lesser parts used, EV can last for a very long time. At least from some reports that we read, we know that it can last about 800,000 to 1.6 million kilometers versus 250,000 kilometers for a conventional ICE cars. Typically, we drove about 16,000 kilometers per year. In that context, it is quite useless for EV to for EV to last so long, because who drives the same car for 50 years, right? But if you are talking about a fleet of cars operated by companies like Amazon, Grab, ComfortDelGro, then the value propositions gets interesting because they can spend lesser in maintaining their fleet of cars and they can drive them longer before there's a need to replace them with newer ones, thus saving the company costs, and adding more to the bottom line. As technology improves, EV price will continue to fall. We will soon reach an inflection point whereby making the choice to drive EV will no longer just be a conscious effort to go green and to do our part in the fight against global warming. It will be fun to drive, easier to maintain, and cost lower. And just like how internal combustion engine disrupted horse riding in the primary mode of transportation, EV will make ICE obsolete. And at that inflection point, growth will accelerate to an S-curve, making all industry experts' projections look too conservative. And this is not the first time that experts have been too conservative in their projection. Take for example on the cell phone again. That's okay, sorry, lost the connection for a while. In 1985, AT&T hired McKinsey, a leading management consulting firm, to predict what the cell phone market in the United States will be like in the year 2000. McKinsey predicted that fewer than 1 million cell phones will be sold in 2000. So AT&T, which practically invented the field of wireless communication at that time, made the decision not to enter the business based on what they thought was going to be a tiny market opportunity. So the smart telecom money was against cell phones in the mid 1980s. And do you want to guess how many cell phones were sold in US in the year 2000? The actual number of cell phones sold was 106 million. The so-called experts' prediction were off the chart by a factor of 106. AT&T eventually entered the cell phone market, but they were late in the game and essentially gave up their market leader position. As I mentioned at the start of the webinar, the future of transportation begins with EVs displacing ICE vehicles, but its end goal is autonomous driving. In the last few years, General Motors has placed big bets on the future of how people get around. For instance, it had acquired the self-driving startup Cruise and kick-started a car-sharing platform called Maven. The auto manufacturer moved beyond renting its own cars to renting out those of its customers. Management wants consumers to look at GM as a brand beyond just an automaker. They wanted to be viewed as a company that provides transportation as a service. So in the near future, owning a car is not just going to be a liability because of the gradual depreciation of price, but the car is going to be an asset for us because at those times that we are not driving, we can contract it to companies like GM, which will then rent it out, and our self-driving car will just drive themselves around, ferrying other customers, thus earning us some money in the process. So, what is an autonomous car? The Society of Automobile Engineers defines the 6 levels of autonomous driving, from no autonomous to full autonomous. So even if for some reason the world never reaches full autonomous, but I think some level of autonomous should be achieved. As such, these are the sectors or assets we can explore investing in. There are multiple ways to gain exposure into the future of transportation as the industry is in a strong tailwind that can last for decades. No doubt, the supply chain issue, further exacerbated by the Russia-Ukraine war, is causing some short-term headwind as the industry struggles to produce fast enough to meet the demand, especially when the world has not fully gotten out of the COVID-19 pandemic yet. But I believe these are short-term issues which can be resolved. It may set the industry back a couple of years, but human ingenuity will eventually find a way around it. So for us, the most direct way, of course, is to invest into car companies like Tesla, GM, Ford, Toyota, so on and so forth. But I think this space is quite competitive and they do not really have a very strong moat to fend off competitors. So other sectors we can explore are those companies that producing lithium ion battery, miners producing the crucial raw materials needed for it, like lithium, cobalt, graphite, and nickel. We can even invest directly into some of these commodity assets. We can also invest into companies that is in the space of LiDAR revolution and semiconductor companies producing the advanced microchips for the auto industry. This is especially when EV and AV stands for autonomous vehicles, need more advanced microprocessors to operate than the traditional ICE cars. And lastly, if you do not want to spend time to analyze the individual companies and sectors, we can simply just invest into EV-related ETFs, exchange-traded funds, to diversify our exposure into this sector. And I've listed here some ETFs for your consideration. In the next section of this webinar, I'm going to share some EV-related stocks for your consideration. The first company, Infineon, is one of the world's leading semiconductor manufacturers. It's headquartered in Germany. Infineon started as a division of the conglomerate Siemens. Eventually, it grew big enough that Siemens spun it out of the company in March 2000. It has historically been known as one of the top suppliers to the automotive industry and connected secure system markets. The, and Infineon actually holds the #1 spot globally for power semiconductors, used across all sectors, including automotive, wireless communications like 4G and 5G, and industrial, among others. We can see from this chart just how dominant Infineon is in the power semiconductor. Infineon has more than twice the market share to its closest competitor in this space. These power management semiconductors regulate the flow of electricity throughout an electrical device. It doesn't matter whether it is the device a smartphone, tablets, automobile, industrial compressor, solar energy inverter, 5G wireless base station. Each of these devices needs Infineon's technology. Infineon is a massive company that generates about 11 billion euro in revenue in the year 2021. It provides solutions to just about anything we can imagine. 44% of its annual revenues came from serving the automotive industry. 30% came from power management and radio frequency division. Infineon's presence in the automotive industry used to represent an 11.2% market share, just barely behind NXP Semiconductors, which has maintained the #1 spot at 12%. But in Japan, Infineon was the #1 semiconductor supplier in the industry. And if you want to be the best serving company in the automotive industry, you have to be strong in Japan. It is home to some of the largest automobile manufacturers in the world, as well as one of the largest Tier 1 automotive supplier, Denso. And in June 2019, Infineon announced that it would acquire a US-based Cypress Semiconductor for $10 billion. By April 2020, he announced that the deal had closed after receiving final regulatory approvals. What are the strategic motivations for this deal? It was for the automotive industry and microprocessors. Within 2 years, Infineon's share price doubled before recent correction brought it back down slightly. The new and improved Infineon increased its market share to 13.2%. Infineon is now the top semiconductor supplier to the automotive industry by a significant margin. And why are all these massive technology companies pursuing the automotive industry so aggressively? A few reasons make the auto sector strategically attractive. Because once you are in, you are in. When you design your semiconductor for an automotive company and you won the business, the revenue will start flowing in 2 to 3 years' time. And because of this, the revenues are highly predictable. It is easy to forecast sales based on the number of cars that will be produced. The amount of semiconductor content per car is rapidly increasing due to the increase of advanced driver assistance systems and autonomous driving technology. The same is true due to the massive shift towards the electric vehicles. The EV market will see an exponential growth over the next 10 years. Currently, only 3% of cars are sold are EVs. Bloomberg predicts that over half the cars sold will have some type of electric power by 2040. That will translate to about 60 million EVs sold annually about 20 years from now. Personally, I don't believe that it will take nearly that long to see the mass adoption of electric vehicles. The shift towards electric vehicles is happening more quickly. The cost of ownership is already lower than a comparable internal combustion engine vehicle. And with battery costs continuing to drop and efficiency improving every year, we will have passed the inflection point. In short, these estimates are too as conservative. But let's say we use the Bloomberg prediction and we assume that we will only see 60 million EVs sold by 2040. The market will still grow by 16% per year. Electric vehicle and even hybrid electric vehicles requires a lot more semiconductors. It's estimated that EVs require more than twice as many semiconductors as an ICE vehicles. So Infineon will be able to potentially double its revenue per car in this fast-growing market, and that's before accounting for self-driving cars. The global demand for advanced driving and advanced driver assistance systems, ADAS, is also projected to spur the market growth for automotive semiconductors and sensors. This system will prove crucial when machines are taking over the control helping driverless vehicles navigate and detect obstacles on the road. Each AV autonomous vehicle comes with an additional $970 of semiconductor content. And with Infineon's acquisition of Cypress, it is gaining a suite of microcontroller, sensor, memory, and connectivity semiconductors that will give Infineon a complete technology solutions for EVs. So we are going to value Infineon based on its enterprise value over the EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization ratio. So Infineon's EBITDA is set to soar over the coming years. As you can see in the table, the current forecast is for EBITDA to grow from 2.98 billion euro in the last fiscal year to 4.44 billion for the fiscal year ending September 30, 2023. Infineon's valuation has traded in the range of between 8 to 16 enterprise value per EBITDA. And right now, it is trading at 8.6 times, closer to the lower end historically. So to make the math easy, let's assume that Infineon's valuation returns to the midpoint of 12. Given how well positioned Infineon is in the automotive and power semiconductor markets, this is likely conservative. It will most likely command a higher multiple in near future. By 2023, Wall Street projects the EBITDA of Euro 4.4 billion. And at 12 times multiple, the enterprise value will be at $52.8 billion. That implies a 40% increase from today's enterprise value of 37.6 billion. The next company, NXP. Just now I mentioned about NXP being one of the top competitor to Infineon. So NXP is helping to lead the industry with the next generation of automotive architectures for the EV industry. The traditional design was largely centralized around a single hub that controlled the entire car. This required a complex mess of wires and cables throughout the car. NXP had been working to decentralize and simplify this model by breaking the car down into control zones and then connecting those zones with less wiring and harness requirements. EV is far more sensitive to weight than ICE are, and this new architecture is specifically designed to reduce the weight of the car. The design reduces the amount of copper wiring by 50%. Combined with a lighter wiring harness, manufacturers can reduce the weight of the car by 45 kg. For an EV, the lighter the car, the longer the distance it can travel. NXP generates about 50% of its total revenue from the automotive industry. It's the most important line of business for the company. And it took NXP decades to become such a dominant force in automotive semiconductors. It has many automotive partners that include Ford, Toyota, Hyundai, BM, Tesla, etc. It has a wide range of product lines serving multitude of functions throughout an EV car. So for example, it supplies parts like the battery management system, which ensure large car battery operates efficiently. It also supplies e-motor control or an inverter. Inverters convert the direct current DC to alternative current AC necessary to move the car. And AC to DC converters, which converts the high voltage from the battery to a lower voltage required by the different systems in the car. You also provide connectivity units to allow over-the-air updates to a car software. Semiconductor manufacturers design their products into the future 3 to 4 years before production. These are called design wins. To be successful in the automotive industry, especially in the area related to safety and key systems, companies really have to play the long game. After a company wins the business, it has to wait 3 to 4 years before it sees its first dollar. So beyond just semiconductors, NXP has also another product line that is crucial to the development of autonomous vehicles. Now, thanks to the distractions from electronic devices such as smartphones, car accidents have been on the rise around the world. Sadly, it's a deadly problem. Collision detection sensors could have helped to avoid many of these accidents. So cars will need a combination of radar and cameras for even the most basic level 1 driver assistance features. Cameras alone aren't enough for the car to make proper safety decisions because cameras can't see through fog or heavy rain or snow or in the dark, and mud can splash over the lens and disrupt the view as well. However, radar gets around those conditions by sending out pulses of electromagnetic waves. It then calculates the time it takes for those waves to bounce off an object and return to the sensor. So the shorter the time, the closer the object. And radar is necessary for even the basic features like autonomous emergency braking. This is a feature that will soon be mandatory in all new cars across the developed world. For example, China's regulators mandated AEB in trucks and high-end cars in 2020. And in 20 car makers in the US agreed to add AEB to 100% of new cars starting in 2022. Japan also mandated this in 2021, and the Eurozone made it mandatory for all new cars to have this AEB starting in 2024. So this is just the beginning. Many car makers already have level 2 or level 3 autonomous features in high-end cars. These increased features require even more radar sensors. The number of radar sensors increased with the level of autonomous vehicles. A full self-driving car will likely have over 10 radar units per car. And this will be another tailwind for NXP. The company is the market leader in radar with approximately 40% market share. Management projects this line to grow 20% a year through 2024. That year, it will bring in around 1.1 billion of sales. NXP is already generating positive cash flow, and it is generating more cash year after year consistently. Wall Street's consensus is for the free cash flow per share to hit $12.40 per share by 2023. And back in 2016, Qualcomm offered to acquire NXP for $47 billion, valuing the company at a price to free cash flow of 24.5 times then. Using a much more conservative valuation of 20 times, NXP target free cash flow of $12.40 per share. Its potential price by the end of 2023 is $250, which is 47% above current price. If we use Qualcomm's valuation of 24.5 times of price to free cash flow, its potential target price by 2023 will be $300, which is almost 80% above current share price. After covering two high-tech firms with cutting-edge technologies, you might find my next recommendation a bit old school. Bob Warner can trace his roots way back to 1880, making horse-drawn carts and bicycle chains. The bicycle chain became an automotive chain a few years later. This company also designed the first real U.S. fighter plane, the MB-3, in 1917. Innovation has always been strong at Bob Warner and the company that he has acquired. For example, in 1909, they manufactured the first manual transmission. In 1912, they invented the spark plug for reliable crank starts used in the internal combustion engine cars. In 1952, they developed turbochargers. In 1980, they introduced advanced 5-speed manual transmission for cars and light trucks. In the year 2000, it introduced a computer-controlled all-wheel drive for passenger cars and crossover vehicles. As you can see, the company has its hand into quite a lot of innovation in the cars we drove today. The full list is much, much longer. The company has a long history of transitioning its business to put itself in a position for the next technology trend. For instance, in 1998, the new trend for engine is to install a turbocharger. This forced more air into the cylinders of the engine so that it could burn fuel faster. It makes the vehicle go faster, and a turbocharger is smaller and lighter than an engine, producing a similar power load without one. So it provides a greater fuel efficiency. As you can see on the chart on the left, after bottoming out in February 2000, turbochargers sent Bob Warner's share price higher. The following 6 years, the company gained 480%, including dividends, that's nearly 30% per year. Then again, in 2010, Bob Warner was able to transition its business to include a new technology called the dual clutch transmission, DCT. This uses two separate clutches for even and odd gears. This allows the car to preload the next gear and shift gear in milliseconds. This makes for a smoother ride and increased fuel efficiency. As you can see from the chart on the left again, in the year 2010 through 2014, the share price returned 370% to its shareholders, or roughly 33% annually. And I think it looks like the company is ready to do it again. BorgWarner ventured into the EV market in 2015 with its acquisition of Remy Motors. Remy produces hybrid motors, which are good stepping stones into electrification and are still popular today. It then acquired Delphi Technologies for 3.3 billion in 2020. Delphi developed a leading inverter for EVs. Inverters are important because they convert the direct current DC power from the batteries to the alternating current AC power used in the motor. Inverters can control the voltage cycles from positive to negative and back again. This is what is needed to control the rotation speed of the motor, which controls the speed of the car. This is an important part of BorgWarner's new integrated drive module, IDM. The IDM includes BorgWarner's transmission and electric drive motor as well as Delphi's high voltage inverter. This is a complete EV motor. All they need to do is to just hook it up to a battery pack, connect it to an axles, to the wheels, and we have a working car. During the 2021 Q4 Investor Day presentation, management laid out an ambitious electrification plan that they named Project Charging Forward. They set a target for growing their EV business solution, which is only worth less than 3% of its overall revenue then, to more than 25% in 2025 and then to 45% by 2030. And their strategy for electrification over the next few years are firstly, to shift organic investments towards electrification. Secondly, they're going to deploy up to 5.5 billion towards M&A. And thirdly, they're going to dispose about 3 to 4 billion worth of revenue that is still in the ICE vehicles business to raise capital and also to better optimize its ICE portfolio. Shedding old product lines is important for any business transition because these deteriorating businesses distract management from concentrating on the growth opportunity. In 2021, BorgWarner acquired company Akaso at 880 million. This gives the company the technology behind the battery packs that it will plug into its IDM. Having this battery tech will help BorgWarner improve its battery charging station. And having a battery pack compatible with the charger will also increase the efficiency of the charge, enabling a faster charge. Akaso will help BorgWarner get a bigger foothold in the commercial EV market. Vehicles like semi-trucks, buses, heavy equipment, etc. BorgWarner is about to become a major supplier in the EV industry. But Wall Street is not coming up to the realization yet and awarding the same valuation to the company as other EV players. Historically, BorgWarner trades between an enterprise value to EBITDA of 5 times to 8 times. Even if its valuation remains the same, and Wall Street never actually wakes up to value it as an EV company, its current valuation of 5 times is almost at its historical low, and thus at a very attractive valuation. Furthermore, the company is not standing still. Bloomberg had projected its EBITDA to continue growing at a pace of 9% per annum over the next 4 years. Now, when the twin engines of multiple expansion and earnings growth work together, investors can potentially see the share price appreciate between 9 to 20% over the next 4 years. 9 to 20% per annum over the next 4 years. So I've almost come to the end of today's webinar. But before we end, I would like to take this opportunity to highlight my work and services. I'm a triple licensed representative specializing in stocks, futures, forex, and unit trusts. I've been with Phillip since 2004 and had over 20 years of experience investing in the financial markets. My clients benefited from my services, including investment advisories in unit trusts and stocks, investment insights based on my personal knowledge and experiences navigating through the markets the past 20 years. This is the list of the WhatsApp and email service alert I provide. On top of that, clients who are keen to learn about fundamental and technical analysis can also talk to me to arrange for a one-to-one coaching session conducted on Zoom or via face-to-face. Please find my contacts here. You can scan the QR code if you are keen to register for a one-on-one coaching session to discuss further. Okay, now we enter to a Q&A session. Okay, there's a question that asks, how do you trade this contract? What is the commission rates and what is the amount to open account? Okay, I'm not sure which contract you are referring to. Perhaps you can leave me your details and then I can get in touch with you for further discussion on this. Okay, one of the common question I always ask these days is, of course, the impact of the Russia and Ukraine war, and that causes a supply chain problem. Especially in Russia is a major supplier of nickel, and nickel is an important ingredient for the production of the lithium-ion battery, especially the newer generation of lithium-ion battery, which uses a lot more nickel. And this newer generation of battery can actually last longer and are more efficient. But how this is going to be an issue in the short term, no doubt. But I believe that over in the long term, the electrification of transportation is a force that cannot be stopped. So this disruption issue will probably have some setbacks that may set back the progress by probably 2 to 3 years, right? But in the long term, I believe that industries will overcome this. And furthermore, like for example, Tesla's major market is in China. And in China, they are actually using the older version of the lithium ion battery, which is actually uses a lot less nickel. So in that context, they are still affected, but probably not as much as in the Western economies, which uses the more advanced lithium ion battery. Do your company offer Tesla contract? Yes, if you are referring to the CFD on the traded on the MT5, we do have a Tesla contract. And you can also trade the Tesla stocks as well. Okay, there's a question on the which EV ETF to recommend. I do not actually, okay, let me go back to the list of the ETF. Okay, I do not actually have a deep study on these various ETFs provided yet. So, but maybe that's something that these are the ETF that you probably can take back and study yourself. If you have specific questions on each ETF, please feel free to drop me an email and then I will probably look into it before giving you my 2 cents worth of reply. As of now, I have not really studied into this ETF in detail, so I cannot give you an answer on that. Okay, what's the amount to open the account? If you are referring to opening an account with Phillip Nova for the futures, forex, and CFD account, there is actually no minimum amount to open it. You can fill up the form to open an account, but when you want to do the trading, because these contracts are traded on a margin basis, so the amount that you need to put in will then depend on the various contracts and contract size that you want to trade in. Okay, the Vix strategy is actually a service that I provide to my clients for the to test run probably for the next 1 year. Currently, I am using this strategy to invest some of my clients who are doing this securities wrap investing with me. Securities wrap is basically um, stocks advisory service whereby client uh, is charged advisory fee on a per month basis, and then I'll be giving advice and to the clients on what to helping them to invest their portfolio based on the investment strategies that I use, and the VIX strategy is one of it. So I am making, because it's something new, and most of my clients have no idea what VIX is. I actually provide this free of charge for 1 year for all my clients to subscribe for them, so that they can just for the next year watch and follow it, and to gain some confidence before they decide if this is a strategy they want to embark in. It is definitely more volatile because it is not actually investing in stocks, but you're trading on a volatility index. Okay, this is my contact. Someone asked for it. You can scan the QR code if you want to register for a one-to-one session with me, or you can just contact me via the emails and my contact number here. Okay, so we have come to the end of today's session. This is our current Earth Day promotion. If you are interested to open a Phillip Nova trading account to trade in futures or forex, you may scan this QR code. Or if you would like to discuss with me further about investing in stocks and receive the WhatsApp and email recommendations that I showed just now, please drop me an email, or you can send me a text on the WhatsApp, and I will get back to you. That is all the time we have for today. Thank you so much for being such a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available in our follow-up email tomorrow. If you have any query on the webinar or would like to get started, simply reply to our email and we will get in touch with you. This is Eric Lee signing off, wishing you great success in your investment journey. Thank you.